Converting cash basis revenue to accrual basis. Okay, journal entry is going to be super important here. Cash basis revenue, right? Well, we're going to deal with, and people find these confusing, and these little graphs and designs here, not unique to here, but people find these confusing, and I don't blame them. These are a little more high level, which is fine, but let's think of journal entries. So if we're going from cash basis to accrual basis, think of our AR and unearned revenue and prepaid revenue journal entries. If AR is going to go up, right? So let's say overall the net effect is, we've got AR of $10,000 and then revenue of $10,000. Well, this is income that needs to be accounted for on accrual basis, but was not accounted for under cash basis. Because how would revenue have been recorded under cash basis? You would have had to see cash for $10,000 and then revenue for $10,000, right? You would have had to see cash actually hit the account. Now, in this case, this is a sale, this is revenue under accrual basis. So this is an example where you'd add to accrual basis because it was not recorded under cash basis and the ending AR balance increases compared to the beginning AR balance. So vice versa, if the beginning AR is the opposite, right? If AR went down, then you are actually going to subtract it out for the same exact reason. When we're dealing with unearned revenue, right? Unearned revenue is cash in the door. So the journal entry here is cash of $10,000. Unearned revenue is a liability account for $10,000. So this is cash basis income, but this is not accrual basis income. As such, you are going to subtract it out. If in this case, you would subtract it out from accrual basis revenue because this is not accrual basis revenue. However, if we have it the other way around, this is something we're going to add to accrual basis revenue. So for all of these, I would write out the journal entry. Every one of these questions that you see with the numbers, write out the journal entry and then think to yourself, is this something that would have, and 99% of the time they'll go from cash to accrual. I mean, technically they could go from accrual to cash, but a lot of times it will just be cash to accrual. Think to yourself, was this included in cash? Should it have been included in accrual? Eliminate it from cash if need be. Or if it wasn't included in cash at all, does it need to be included in accrual? Then add it or subtract it from accrual, right? Write out the journal entries. Journal entries don't lie. They tell a story. And they're going to be how you're going to answer the questions in this part, in this chapter. Now, same thought process here. Same thought process. We are going to look at our journal entries. So to convert cash basis to accrual and vice versa, you need to understand the relationship between beginning and ending balance sheet accounts. Think to yourself, what journal entries cause these accounts to increase or decrease? As questions they're going to give you, beginning and ending balances of balance sheet accounts and expect you to know how this change affects revenue. We just dealt with revenues. How do we deal with cost of goods sold? Well, cost of goods sold, first off, think the journal entry. How do we increase cost of goods sold or expenses really for our cash basis? Well, that's going to be debit expense for $10,000 and credit cash. However, for accrual basis, we're not going to see that. We're going to see this. It's going to be when this happens, right? Now, if immediately you pay it in cash, yes, sure. But it's when it's incurred. So when it's incurred, you probably would book the AP and then you would do cash. But that's the difference here, right? So if overall AP is higher than at the end than at the beginning, that means that overall you spent more than was recorded for cash purposes. And as such, you need to add it to your ending cost of goods sold. And cost of goods sold is going to be your accrual-based account. And similarly, ending inventory, right? If you end up with more ending inventory at the end of the period, at the end of the year, you're going to subtract that out from cost of goods sold. Let's look at that journal entry. So if overall inventory went down, we are going to have cost of goods sold. Like, what's the overall journal entry for ending inventory being reduced? You see here, that's cost of goods sold being increased because it's a debit to an expense. Write out these journal entries. Practice and write out each of these journal entries, how you would get the overall net effect. Now, yes, obviously there's a bunch of transactions throughout the year that make it so that the ending AP is greater than the beginning AP. But what's the overall net effect on the journal entry, right? Like overall, you're going to have a net journal entry. Now we have some operating expenses. Again, nothing's really different. Like nothing's different from this. It's just what journal entries got you here. Well, I would kind of memorize not even memorize, just think about it. So this formula converts cash basis operating expenses to accrual basis operating expenses. Now, how do you get the difference here? We have prepaid and accrued. These are all accrual basis accounts. You don't see these in cash basis. So as such, you need to account for them, and changes in them are going to increase your accrual basis operating expenses. You're going to start with your cash basis operating expenses. It's a good place to start. So overall, if you ended up accruing more throughout the period, you didn't see that in cash basis, but you have to add it to your accrual basis operating. And similarly here, your prepaid expenses, this is you using them up, right? The prepaid expense is an asset. So overall, what would be your journal entry for a reduction in prepaid expense? Well, I'd say expense for $10,000, and then prepaid expense, which is an asset for $10,000. This is the journal entry for this third point here. This reduces your prepaid expenses, overall net effect of a decrease. As such, it's an expense that's recorded on the accrual basis that would not have been accounted for under cash basis because I don't see a cash account here. That's what's going on. This section confuses a lot of people. It definitely does. And I understand that. And that's why I'm going with the journal entry approach. I think that is the most clear, the best way to display it for yourself. It's how I enjoyed learning it. And so, yeah, anything here, this formula can be used for any expense. So if you're dealing with beginning, like wages payable, right? Beginning wage expense, you've got wages payable. If you're dealing with income tax expense, any type of expense, we'll think of what is the accrual account that is relevant here. It's the account that would not have touched cash basis, right? This would not have been picked up under the cash basis of accounting.